Hello and welcome to the first class of regulation. In Reg 1, we'll cover federal income tax that individuals need to pay to Uncle Sam. Now, Uncle Sam, that's the expanded form for US. And we're going to start Reg 1 with Form 1040. So that's the form that all individual taxpayers need to file with the IRS or Internal Revenue Service, which is a bureau of the US Treasury Department. Now, IRS's job is to collect internal revenue for the US federal government, or as we would refer to it, Uncle Sam. Now, to start with, Uncle Sam wants to know what all you've been earning, all your income during the year, your gross income. So we're going to look at your salaries, we're going to look at your business income. So all that's money you've been working really hard for. Or did you smartly invest your money in bonds or stocks where you got interest income or dividend income? Or do you own some real estate property which got you passive income like rent? Or did you just sell your $100,000 house for $1 million? So that's capital gains for you. Now, even if you went to Vegas and with your intellectual genius, you made $500,000 in gambling winnings. So all that is gross income on your Form 1040. So when you actually fill up your 1040 and you have your gross income in place, you're surprised that you earned so much money, because now you see nothing. It's all gone. You spend it all. You've been paying your student loan. You've been paying alimony to your divorced spouse. Now that really takes a toll on you. You've been paying medical expenses. You've been paying tons of other taxes to your state government, to your local government. Let's say you've been paying interest on your home loan. Or let's say you went for therapy and now every month you're paying out money to charity. Now when you tell all this to Uncle Sam, his heart melts just a little and he tells you, okay buddy, we'll give you some deductions. So he starts with adjustments. So from your gross income, you have some adjustments which are allowed, some deductions which are allowed for you before you get to your adjusted gross income. Look at this. Gross income less adjustments. This becomes adjusted gross income. So adjustments are basically your deductions to AGI, or we would call it above the line deductions, because if you look at this line, these adjustments are above the line deductions. And that's not all. From AGI, you're allowed another set of deductions. So these are deductions from AGI or below the line deductions. So you could take deductions for your medical expenses, your taxes, your interest payments on your charity, on your casualty, job related expenses. All these become itemized deductions. Now, if you don't have a lot of itemized deduction, you could go for a fixed dollar standard deduction. Which one would you go for? Standard or itemized? Whichever is more. So standard deduction, so that's a fixed dollar deduction. So let's say for 2013, the standard deduction for individual single taxpayers was $6,100. Now, if you have itemized deductions above this level, you're going to go for itemized. If not, simply go for standard deduction from AGI. And Uncle Sam also allows you some exemptions for all whom you support. So let's start with you yourself. Do you pay for yourself? Do you support yourself? If yes, take an exemption for yourself. Do you support your wife? If you do, take an exemption for her. Do you support your children? If yes, you got exemptions for them. Do you support your parents, your relatives, your cousins? You got exemptions for all whom you support. So it's a fixed dollar number, $3,900 for 2013 multiplied by the number of individuals you support. So we're going to start with your gross income, all that you earned during the year, less some adjustments, some deductions to AGI, which gets you to your adjusted gross income. From there, you could take a standard deduction or itemized deduction. So these are deductions from AGI. You could go for exemptions, and this gets you to taxable income. Now we're going to calculate your taxes based on your relevant tax slabs. And then again, from your tax, we're going to allow you some tax credits. So tax credits, these are dollar for dollar deductions. Think about it. If you have an adjustment or itemized deduction, let's say for $100, and you're in the 30% tax slab, so that deduction helped you save taxes by $100 into 30%, $30, because that reduced your taxable income by $100, reduce your taxes by $30. But if you have a tax credit for $100, that helps you reduce your taxes dollar for dollar, $100 reduction of your taxes. Now, that's not all. We're moving on. Now we get to AMT. So now Uncle Sam wants to see whether you ended up taking a lot of deductions. If yes, you might have to pay alternative minimum tax. Basically, Uncle Sam tells you, if you think you've been too smart here, he's smarter. And then you also have self-employment tax. So let's say you were running your own business during the year. You never paid payroll taxes because you didn't get salaries and wages. So now you pay self-employment tax on your self-employment income. And this is in addition to your income tax. Now, let's say you've made some tax prepayments during the year, or your employer has withheld taxes from your salaries which he paid directly to Uncle Sam. Now, that's all deducted before we can calculate your tax due at the end of the year. I know, all this looks so interesting, and I'm going to add some more spice here with my funny mnemonics. So let's start with all of them. I'm going to give you all of them, and we're going to discuss it throughout Reg 1. So let's start with the mnemonic for gross income. Now, first we're going to look at a lot of schedules for gross income. So we're going to look at Schedule B, Schedule C, Schedule D, Schedule E, Schedule F. So Schedule B is your interest and dividend income. Schedule C is your business income. Schedule D, capital gains. Schedule E, income from passive activity. Schedule F, farm income. Lot of schedules. And then comes my mnemonic, as I row up. So think about yourself. You're going to be filthy rich after you're going to be CPAs. And on 31st December, you have a cruise party where you are rowing upstream on your lovely new yacht. And now you say, as I row up. Now, after you reach the top, you really want to test the waters. So what you do is, you get your shirt off, you jump into the waters. And now for adjustments, you'll have your mnemonic, had, set, swim. Interesting. So as I row up, I had, set, swim. Now, by the time you approach your tax filing, 1040 filing deadline, by the way, that's 15th of April, you remember all that I taught you. You remember all my mnemonics. And you also remember Miles, which provided you the right platform to get to your destination CPA. And you of course remember that Miles takes interest in charity, pretty philanthropic, and casual jolly meets. Lot of networking at Miles. So guys, that's your mnemonic for itemized deduction. Moving on. By the time you get your tax credits on your 1040, you'll be tired and exhausted. And I'm going to motivate you. I'm going to push you by telling you that you got to be an ace deer if you want to be a foreign business winner. So guys, your mnemonic for tax credits is going to be ace deer, means foreign business winner. So as I told you, you got your form 1040 which works gross income less deductions to AGI gets you to your AGI, less standard or itemized deduction less exemptions taxable income multiplied by tax rate gives you federal income tax, less tax credits plus AMT plus self-employment tax less any payments, your tax due on your 1040. And to remember a lot of the content, we'll have funny, interesting mnemonics. So for gross income, we look at a lot of schedules to your 1040 plus your mnemonic as I row up. Adjustments, hat, sit, swim. Itemized deductions, we'll talk about miles, which takes interest in charity and casual jolly meets. And then I'm going to tell you, you ace dears, you're going to be foreign business winners. Exciting, isn't it? Let's look at Form 1040 on page 5 of Reg 1. Highlight Form 1040 and this is the US individual income tax return. Highlight individual. So you start with filling in your first name, your last name, your social security number, and if it's a joint return, you fill in your spouse's first name, last name and social security number. Then you put in your home address, your city, town, state and zip code, and then it's time for you to highlight filing status. We'll also be looking at highlight exemptions, which you get for yourself, your spouse and your dependents. So right there, line 42. Then move down. We are looking at highlight income. And from line 7 to line 22, draw a bracket and write gross income equals schedules plus as I row up. So let's just find out all the schedules that we have under gross income. So look at line 7. You got wages, salaries, tips, etc. Attach, highlight Form W2. Now this is not a schedule that you fill. You get Form W2 from your employer, but it's pretty important out here. On line 8A, we're looking at taxable interest and it says attach, highlight Schedule B if required. Look at line 9A, ordinary difference, again attach, highlight Schedule B. Then on line 12, where we have business income or loss, highlight Schedule C. Line number 13 is capital gain or loss and highlight Schedule D. Look at line 17, which is rental real estate, royalties, partnerships, S corporations, trusts, etc. Attach, highlight Schedule E. So this is all passive activity. Line 18 is farm income, highlight Schedule F. So all the different baskets of income from line 7 through line 21 gets us to line 22, which says combine the amounts in the far right columns for lines 7 through 21 and highlight this is your total income. Draw a bracket from line 23 through line 36 and write there adjustments equal had, set, swim. So that's a mnemonic for all the adjustments that we have from gross income. Now look at line 37. It says subtract line 36, that is the sum of all the adjustments, from line 22. So that's the line for gross income. And highlight this is your adjusted gross income. So draw an arrow out from line 37 and write AGI. So now we can see that gross income less adjustments gets us to AGI. That's the last line on the first page of Form 1040. Turn to page 6 and here we are looking at the second page of Form 1040. So put a box around page 2. Look at line 38. This is amount from line 37, which is highlight adjusted gross income. Then let's go to line 40, where we have highlight itemized deduction from Schedule A, circle or, and highlight standard deduction. So you could either fill up form Schedule A and go for itemized deductions, or you could have a standard deduction. And look at the left margin now. So if you're a single taxpayer, your standard deduction for 2012 is highlight $5,950. If you're married filing jointly, in that case, your standard deduction is highlight $11,900. So as I told you, standard deduction, that's a fixed dollar number. Itemized deductions that we're going to look at in Schedule A would be mild stakes interest in charity and casual jolly meets. So you'll have a lot of personal expenses that you could deduct out there. Now, you would generally take whichever is larger. So if your itemized deductions are larger than the dollar number, you would go for itemized deductions. Else, you could simply take a standard deduction. Now looking at line 42, we have highlight exemptions. So it says multiply highlight $3,800 by the number on line 6D. So on the previous page, we had seen exemptions where you had exemptions for yourself, your spouse and your dependents. So the total number of exemptions that you've claimed multiplied by this fixed dollar number $3,800 for 2012 would give you your total exemptions for the year. And this leads you to line 43, where you have highlight taxable income. On this taxable income, you calculate highlight tax on line 44. On line 45, we're looking at whether you're liable to pay any highlight alternative minimum tax. From line 47 through line 54, draw a bracket and write tax credits and within brackets non-refundable. So these are non-refundable tax credits. And on line 54, highlight total credits. From line 56 through line 61, we got other taxes. And our focus here is highlight self-employment tax. And this is from highlight Schedule SE. On line 62, highlight federal income tax withheld from forms W2 and 1099. Underline withheld and write there W2 equals employee. So form W2 is used to report wages paid to employees and the taxes withheld from them. So the employers must complete a form W2 for each employee to whom they pay a salary, wage or other compensation as part of an employment relationship. Then write 1099 equals non-employees. And within brackets write example independent contractor. So form 1099 is used to report various types of income other than wages and salaries. So a good example is amounts paid to a non-corporate independent contractor for services. On line 63, highlight estimated tax payments. So lines 62 plus 63, we are looking at the sum of income tax withheld from your income as well as the tax payments that you have made during the year. Now put a bracket from line 64 through line 66 and write there tax credits and within brackets refundable. So the earned income credit or the additional child tax credit or the American opportunity credit, these are refundable tax credits. Then come down to line 76 where we have calculated your taxes due. Highlight amount you owe. Then you have space for your signature. If it's a joint return, both your spouse and you are supposed to be signing here. If you have used a paid preparer to prepare this return, he's going to print his name, sign here, write his firm's name and address. So right there, if prepared by, and put a box around paid preparer. So that's about the 2 pages that you have on Form 1040. Now turn back to page 4, where we're going to look at an overview of this Form 1040. So as we've seen, we're going to start with gross income, which of course includes schedules B, C, D, E and F. And it's got a few line items, and our mnemonic for that is write plus as I row up. From gross income, we're going to deduct adjustments. So adjustments are actually right above the line deductions or deductions to AGI. And our mnemonic for adjustments is right had, set, swim. So gross income less adjustments gets us to adjusted gross income. So we've seen this is the last line on page 1 of 1040. Now after we've calculated adjusted gross income, we're going to have standard deduction or itemized deductions. So these are right below the line deduction or deduction from AGI. If you take standard deduction, that's a fixed dollar number. But if you're taking itemized deduction, you need to fill out Schedule A. And your mnemonic to remember all the components of itemized deductions is right miles, takes interest in charity and casual jolly meets. So looking at it once again, we got gross income less adjustments gets us to AGI, less standard deduction or itemized deduction Schedule A, less exemptions that you get for yourself, your spouse and your dependents, and this gets you to taxable income. Multiplied by the tax rate depending on your tax slab, you're going to calculate federal income tax. From that, we're going to subtract tax credits. And we saw both non-refundable as well as refundable tax credits. And our mnemonic to remember all the tax credits that we have here is right ASDR equals foreign business winner. Then we're looking at alternative minimum tax, self-employment tax on Schedule SE, less any payments which have been made, which include tax withholdings on W2 or 1099 or estimated tax payments that you've already made to the IRS during the year. And this helps you calculate amount you owe or taxes due. Now let's turn on to page 9, where we're going to address a couple of questions regarding who must file Form 1040 or what's the deadline to file this form. So it says individuals must generally file the tax return Form 1040 if any of the following conditions apply. Highlight income is greater than the sum of personal exemption plus standard deduction on self. That means you're earning more dollars than the exemption plus deduction amount. Highlight net self-employment income of $400 or more. It's because on self-employment income, you're not only paying federal income taxes, you are also paying self-employment taxes. Now you have an option of highlight may file form 1040 EZ or 1040A. So 1040 EZ, that means it's an easy form, underline shorter version. So you can file 1040 EZ or 1040A if taxable income is below $100,000, you got no self-employment income and certain other requirements are met. Now you got to note that form 1040 EZ or form 1040A underline allow only standard deduction. Which means if you're going for itemized deductions on Schedule A, you got to file the full form 1040. You cannot go for 1040 EZ or 1040A. Looking at the next question, when to file form 1040? So right there, by 4/15, that's 15th of April plus 6 months. And highlight, file by 15th April with a provision to obtain a 6-month extension up to 15th October. And underline, 6-month extension is granted automatically to the taxpayers on filing form 4868. But this extension is only for time to file, not to pay. So highlight, pay tax by 15th April. Extension is for filing only, not for tax payments. Now, if you don't file on time or you don't pay on time, then you would be liable for penalties apart from any interest. So underline, late filing or no filing penalties of 5% per month, and this is calculated on your net tax liability. And you also have underline late payment penalties of 0.5% per month on your net tax liability. Now, if you want to amend your returns later or claim a refund, you could file highlight form 1040X and underline amended returns, circle or and underline claim of refunds. And 1040X highlight may be filed up to the later of 3 years after original due date or 2 years after actual tax payment. On the last bullet, we are looking at highlight IRS's statute of limitations. So that's the time period that IRS has to come back to you for taxes due. If there is an highlight error, IRS has got highlight 3 years. But if there is a gross negligence or your gross income has been understated by 25%, IRS has got highlight 6 years to come back to you. But if there is highlight fraud or failure to file, then it's unlimited time period that IRS can come back to you for your taxes due. Let's now talk about filing status on your form 1040. So let's say you're unmarried, which means you're still enjoying life to the fullest. On your 1040, you're going to call yourself single. But if you are married, you get two options here. You could be a married filing jointly, where your spouse and you file a joint return with the IRS. That means one return for the two of you. Or you could be a married filing separately, where your spouse and you file two separate returns with the IRS. So if you're married, you got these two options. Now most married couples, they go for married filing jointly because this doubles your deductions. Your spouse's income and your income is now treated as one entity, and there are a lot of other tax incentives. So even if you guys have been fighting all around the year, at year end the IRS brings you closer, brings you together, at least for taxes. But if there's nothing that can keep it together, not even tax returns, then you end up being married filing separate. Now remember, we are looking at your marital status on 31st December. That means even if you get married at New Year's Eve, you would still be treated as married, and you could be a married filing jointly or married filing separately. But if you got divorced or legally separated during the year, you would be considered single. Now let's say you're single, but you run a household, a home where you provide for certain dependents. Now you could qualify as a head of household. So here you are a single, but you run a household where you have, let's say, a dependent child, or you're taking care of your dependent parents, or you got dependent relatives. So we can look at your siblings, your uncles and aunts. So when we're talking about your dependent child, the criteria is the dependent child should be living in your household for at least half the year, and you should be providing for at least 50% of the cost of running that household. Again, when we're looking at dependent relatives, they should be living in your household for at least half the year where you are running the household, because you are the head of household. Now, a good way of remembering this is, whenever we're talking about head of household, we're focusing a lot on the letter H. So we're talking about half year. Okay, when we're looking at dependent parents, they could live in with you, that's okay. But even if they're living in a retirement home, not in your house, and you are providing for over 50% of their upkeep costs, you could still be a head of household. So as you understand, when we're talking about head of household, we are generally looking at single parents who take care of the dependent child living in with them for over half year. Or we are looking at responsible citizens who take care of their parents. Even if the parents are living in a retirement home, they are paying for their upkeep costs. So they are heads of household. Now, a head of household has a more lucrative, a better tax slab than a single. Now, coming to our final filing status, qualifying widow or widower. So let us say your spouse died during the year. Now, in the year of death, you could still be a married filing jointly. That means though she's not there with you, the IRS makes sure that she's at least together with you on your tax return. So in the year of death, you still married filing joint. And for the next 2 years, you could go for the qualifying widow or widower status, provided you're still single. That means you've not remarried, and you have a dependent child. We're looking at your own child or your stepchild or an adopted child. So you got a dependent child, but the criteria here is that the dependent child should live in with you for the whole year. So in head of household, we said half year is okay. Qualifying widow or widower, it's W and W, whole year. And naturally, you are providing for over 50% of the cost of running the house. So guys, in case of qualifying widow or widower, we're looking at your spouse having died, and you could have this status for up to 2 years after spouse's death, provided you haven't yet remarried, because the moment you remarry, again you're going to be married. Married filing joint, married filing separate. But if you haven't remarried, you are single and you are having a dependent child living in with you for the whole year, and you running the cost of that household. So guys, as you can understand, these are all the filing status. You would be choosing any one of them. If you're married, you got limited options. You could be married filing joint or a married filing separate. If you're single, you could be single, you could be a head of household, you're looking at single plus providing for dependents, or qualifying widow, widower. That's only when your spouse has died, and this is up to 2 years after spouse's death. So let's get to the book, look at all this filing status. And I'm going to touch base on these again when we are talking about exemptions. Because remember, we said you're getting exemptions for dependents. So when we get to exemptions, I'm going to explain you in further detail about dependent child and dependent relative. We're looking at filing status on page 10. Highlight single, highlight married filing separately and married filing jointly. Put a bracket around all three and write status as of December 31st. Next, highlight qualifying widow or widower. And you get the same tax slabs as married filing jointly and joint standard deduction allowed, underline up to 2 years after death of spouse. And the second rule is you need to put a box around a dependent child, own child, stepchild or adopted child living in with you for, underline, whole year, and you're providing for, underline, over 50% of cost of maintaining the household. On the bottom of this page, make a little note, right? If spouse dies, year 1, that's a year of death, you still write married filing jointly. Years 2 to 3, that's 2 years after death, right, may be qualified widow or widower. That is, if you have a dependent child living in with you for the whole year and you providing for over 50% of the cost of maintaining the household. Right, thereafter, may be head of household. Move to page 11 and highlight head of household. Now the first rule is you need to be single, and you need to be maintaining a household where any of the following dependents live in at least for half a year. Put a box around dependent child and write that, for example, a divorced parent. Now, the dependent child could be an own child, stepchild, adopted child, could be a foster child or a grandchild, even a sibling, but required to live in with the taxpayer for over, underline, half year. And the taxpayer must provide for, underline, over 50% of cost of maintaining the household. Next, put a box around dependent parent. Now for dependent parents, they are not required to live with taxpayer. Right there, retirement home is okay. But the taxpayer must still provide for, underline, over 50% of parents' support or upkeep costs. Now the dependent could also be, put a box around, a dependent relative. It could be an uncle, aunt, nephew, niece, few step relatives or few in-laws, but they cannot be, right, not cousins or freeloading friends who come in and live at your place. But the dependent relative is required to live with taxpayer for over, underline, half year. And the taxpayer must provide for, underline, over 50% of cost of maintaining the household. Towards the bottom of the page, we got a lovely table where we are comparing the qualifying widower status requirements versus head of household requirements. Put a star there. So under qualifying widower, we are only looking at a dependent child, that's an own child or a stepchild. But in case of head of household, we are okay with any child, any relative or parent. Now under qualifying widower, the child needs to live in with the taxpayer for the whole year. Whereas in head of household, half year is okay for child and relative. For parents, they're not even required to live in with the taxpayer.